First of all, you got to be careful when you're structuring split dollar because it may or may not be subject to the Section 49A restrictions. And if it is, you just have to make sure that it's structured properly and that you follow the compliant structure and don't freelance, right? So that's point one. Point two, and just for your listeners, there's sort of two split dollar structures that can be used. One is, I mean, there's many, but two general categories. One is where the employer owns the policy and is going to pay the benefit, the net benefit after they get their premiums back over to the beneficiary who is named by the covered employee, right?
And that is called endorsement split dollar, usually with an economic benefit equal to the taxable amount above $50,000 in that economic year, based upon your current age. That's the definition behind it from a legal standpoint. Dan,
Right, exactly right. And then the other structure is what's called a collateral assignment, where the insured actually owns the policy, but they have executed a collateral assignment to pay back to the employer the premiums that the employer pays and possibly some interest. So you can structure it different ways. To the extent that the interest that's being paid or being charged being charged against the policy in favor of the employer's advances is less than the applicable federal rate, then you're going to have to impute income for essentially forgiven interest on the loan.